Texas has long been a symbol of growth, booming cities, job opportunities, and affordable housing that drew families from across the U.S. Jobs are disappearing, young people are leaving, and housing markets that once seemed stable are showing cracks. In this video, we'll explore 10 Texas cities on the path to becoming ghost towns. These aren't just small blips on the map, they're communities facing structural problems that no quick fixes can solve. And while some of these places might look like bargains today, the risks lurking under the surface could turn those cheap homes into financial traps. Make sure you hit that subscribe button so you don't miss our deep dives into the housing markets that could make or break your next move. Stick around until the end, because the last city on our list isn't just struggling, it's a warning sign for the entire state of Texas. 10. Wichita Falls. Wichita Falls, with a population of about 102,000, once thrived as a regional hub. Its name even suggests energy and motion, but today the motion is mostly outward. Young people moving away in search of opportunity. Over the past decade, Wichita Falls has lost nearly 3% of its population, a slow bleed that chips away at the city's housing demand. The economy here is dominated by Shepherd Air Force Base, healthcare, and light manufacturing. While these industries provide stability, they don't generate the wage growth needed to keep housing demand strong. Median household income in Wichita Falls is just $54,000, well below the Texas average of $72,000. Meanwhile, the median home price has climbed to $180,000, still affordable by state standards, but increasingly out of reach for locals when paired with stagnant wages. The housing data tells the story. Homes here spend an average of 75 days on the market compared to just 35 statewide. Inventory has risen by nearly 25% year over year, and foreclosure filings are up 18%. Rental demand is weak too, with average rents at $950 per month, among the lowest of any Texas metro. That might sound like a good deal, but low rents often mean there's no competitive pressure to drive investment or development. Builders see little incentive to expand, leaving the housing stock aging and less attractive to newcomers. Another concern is demographics. Nearly 20% of residents are over 65, one of the highest shares in Texas. With more retirees and fewer young families, the market leans toward decline rather than growth. Educational attainment is also lower than the state average, limiting the city's ability to attract new industries. The challenge for Wichita Falls isn't just affordability, it's relevance. Without stronger industries or consistent population growth, the city risks becoming stagnant, leaving behind a housing market that looks cheap but keeps sliding. For investors, that's a trap. For families, it's a warning sign that the bargain may cost more than it seems in the long run. 9. Abilene. Abilene, with a population of about 125,000, is another city caught in Texas's quiet housing crisis. Known historically as a military and religious hub, it's home to Dyess Air Force Base and several small universities. But despite those anchors, Abilene has struggled to retain its younger population. More than 20% of residents are over the age of 60, creating a demographic imbalance that leaves housing demand fragile. Median home prices in Abilene are around $210,000, which seems affordable compared to Dallas or Austin, but median household income here is just $56,000, meaning the price-to-income ratio is creeping above 3.5 to 1, well past the affordability comfort zone. At today's interest rates, monthly payments for a modest home exceed $1,800, stretching family budgets in a city where wages are stagnant. Housing supply is swelling, listings are up 30% year over year, and homes are taking more than 80 days to sell, double the pace of just 2 years ago. New construction has slowed sharply, leaving half-finished development scattered around the city's outskirts. The economy is stable but uninspiring. Healthcare, education, and the military dominate, but none of those sectors create the kind of high-paying jobs needed to lift housing demand. In fact, Abilene's unemployment rate, while not alarming at 5%, is higher than the Texas average, and job growth has been flat for years. The long-term concern is outmigration. Younger residents, especially college graduates, are leaving for Dallas, Austin, or even out of state, draining the city of both talent and buyers. With fewer new families moving in, demand weakens, prices stagnate, and the market begins to hollow out. Abilene may not face a dramatic crash, but it faces something just as damaging: slow decline. And in housing, slow decline can quietly erode wealth just as much as a sudden collapse. 8. Killeen. Killeen is a city of contrasts. With a population of about 160,000, it's larger than many people realize. The city is almost entirely defined by Fort Cavazos, formerly Fort Hood, one of the largest military bases in the world. That makes Killeen's housing market unique and highly vulnerable. During the pandemic, Killeen saw a flood of buyers and investors, many drawn to the city's relative affordability. Median home prices jumped nearly 35% between 2020 and 2022, peaking around $250,000. For a while, it looked like Killeen was entering a golden age of growth. But that growth was built on shaky foundations. Median household income in Killeen is just $56,000, meaning many local families are already priced out of the market. At current rates, the average monthly mortgage payment here is about $1,900, consuming more than a third of income. For households living on military salaries, often modest and with limited flexibility, the pressure is even higher. The real risk, however, lies in the city's dependence on the military. Nearly 45% of the local economy is tied directly to Fort Cavazos. If federal defense spending shifts, if troop numbers are reduced, or if operations scale back, Killeen's housing market would feel the impact almost immediately. The same dynamic has played out before, in the early 1990s, when base realignments triggered sharp housing declines. Even rumors of troop reductions have historically frozen the local housing market. Signs of strain are already emerging. Inventory is up 32% year over year, and foreclosure filings have increased 20%. Many of these foreclosures are tied to VA and FHA loans, popular among military families, where small down payments leave little cushion if values fall. This creates a dangerous cycle. When foreclosures rise, values drop further, trapping more families underwater. Rental markets are equally fragile. The city has one of the highest shares of renters in Texas, with nearly 60% of households renting instead of owning. While that keeps demand steady, it also means fewer long-term owners, less stability in neighborhoods, and greater volatility when soldiers are reassigned. Oversupply of rentals, including short-term military housing, has already begun to push rents down by nearly 8% since 2022. Killeen is not collapsing yet, but its dependence on a single economic engine makes it one of the most vulnerable housing markets in Texas. If military spending wobbles, so will Killeen, and history suggests it's only a matter of time. 7. Laredo, sitting on the US-Mexico border, is a city of nearly 260,000 people. It's the largest inland port in the United States, and its economy revolves almost entirely around international trade. Trucks and trains carrying billions in goods cross here every year, keeping warehouses and logistics centers busy. That gives Laredo stability, but also fragility. Median home prices in Laredo are around $210,000, which is technically affordable by state standards, but the local median household income is just $54,000, leaving a tight gap. At today's rates, a standard mortgage would consume nearly 40% of income for the average family. This puts many households on the edge of being priced out, especially since rents have also jumped to $2,250 per month, up more than 20% in just 3 years. For a city where nearly 1 in 5 families earns less than $30,000 annually, even renting is becoming unsustainable. The market is showing strain. Homes linger on the market for 70 days on average, compared to 40 days statewide. Inventory has risen 25% year over year, while foreclosure filings are up 15%, a warning sign for a market that hasn't historically seen sharp swings. Builders are also slowing new construction, leaving several developments half empty, a reflection of waning demand. The long-term risk comes from demographics and economics. Laredo's population is young and growing, but wages are stagnant. Nearly 25% of residents live below the poverty line, more than double the Texas average. That creates a mismatch, a growing population, but one unable to afford rising housing costs. Add in the volatility of international trade, sensitive to tariffs, border slowdowns, or political disputes, and Laredo's housing market looks far more vulnerable than its price tag suggests. Laredo isn't collapsing yet, but its reliance on cross-border trade and its weak income base make it highly exposed to external shocks. In housing terms, that means values can slip quickly if the economic engine stutters, leaving buyers and investors suddenly underwater. 6. Beaumont, home to about 115,000 residents, is an oil town through and through. Its identity is tied to the energy industry, with refineries and petrochemical plants dominating the skyline and the job market. For decades, this reliance brought prosperity, but in 2025, that dependence is looking more like a liability than a blessing. Median home prices in Beaumont are about $185,000, some of the lowest among Texas mid-sized cities. On the surface, that looks affordable, but median household income is only $52,000, and the city struggles with persistently high unemployment rates, hovering around 6%, well above the state average. With mortgage rates where they are, even Beaumont's cheap housing feels out of reach for many locals. The housing market data reflects the stress. Homes here spend 85 days on average on the market, nearly 3 times longer than in Houston. Inventory is up 40% year over year, and foreclosure filings jumped by 22% in the last 12 months. Even new construction is slowing, with several developers pausing projects after demand collapsed, leaving unfinished lots across the metro. Natural disasters add another layer of risk. Beaumont sits in a hurricane-prone zone, and storms like Harvey in 2017 left scars that still shape insurance rates today. Premiums have doubled in the past 5 years, with many homeowners now paying more than $4,000 annually just for insurance. For lower-income families, that's an unsustainable cost, and for potential buyers, it's often a deal breaker. The local economy compounds the vulnerability. With such a heavy dependence on oil and gas, Beaumont's fortunes swing with global energy markets. In downturns, layoffs spike, demand dries up, and housing values slip. Unlike Houston, which has diversified into healthcare and tech, Beaumont hasn't built alternative industries to cushion the blow. That lack of diversification makes every economic shock feel sharper and longer lasting. Beaumont's housing market is fragile because it rests on one leg: energy. If that leg wobbles, the whole structure shakes, and history shows it often does. Before we continue with the next city, don't forget to subscribe to the channel. Your support helps us keep bringing you quality content and in-depth research on America's changing housing markets. 5. Odessa. If Beaumont is an oil town, Odessa is an oil town on steroids. With about 115,000 residents, Odessa is one half of the Permian Basin's energy capital, paired with nearby Midland. This region pumps out more oil than some entire countries, and when prices are high, Odessa thrives. But when prices crash, so does everything else, including housing. The boom and bust cycle defines Odessa's real estate market. During the 2010s, home prices climbed as oil surged, peaking again during the pandemic rebound. Median home prices now hover around $230,000, but they mask the volatility underneath. In 2016, during an oil downturn, prices fell by nearly 20% in 2 years. A similar dip happened in 2020 when pandemic lockdowns crushed energy demand, and entire neighborhoods saw for sale signs multiply overnight. Today, signs of strain are visible again. Active listings are up 35% year over year, and homes take more than 90 days to sell on average. Foreclosure activity has spiked by 25%, particularly among households tied directly to oil field jobs. Renters aren't immune either. Average rents are around $1,300 per month, but vacancy rates are climbing as transient workers leave during slowdowns. Investors who purchased during the boom, expecting steady rental income, are now struggling to cover mortgages, adding pressure to sell. The city's economy is overwhelmingly tied to oil and gas. More than 50% of jobs depend on it directly or indirectly. That makes Odessa's housing market one of the least diversified in Texas. Even infrastructure struggles under the weight of boom cycles. Schools overcrowd during growth years, then empty during downturns. Roads and utilities expand too fast, then sit underused when demand falls. Healthcare and retail jobs exist, but they primarily serve oil field workers, meaning they contract as well when the industry slows. What makes Odessa especially risky is how quickly it swings. In a matter of months, housing demand can collapse, leaving owners underwater and investors scrambling. Long-term stability is almost impossible here because the market follows the global oil price chart more than any local factor. The last 2 decades show the same pattern. Every oil crash leaves deeper scars, with abandoned projects and foreclosed homes marking the landscape. Odessa offers opportunity in boom times, but in busts, it can turn into a housing nightmare. And right now, with energy markets facing uncertainty and geopolitical tensions reshaping demand, the risks are rising again, fast. 4. McAllen, deep in the Rio Grande Valley, is often described as one of the most affordable places in America. With a population of about 145,000 residents and part of a metro area nearing 900,000, it has long attracted attention for its low housing costs compared to the rest of Texas. But what looks like affordability on paper hides serious vulnerabilities. Median home prices in McAllen are around $180,000, among the lowest of any city on this list. At first glance, that seems like a bargain, but the problem is income. The median household income here is just $49,000, far below the state median of $72,000. That creates a hidden affordability problem. Even with cheap houses, many locals still struggle to qualify for mortgages or make monthly payments. At today's rates, a modest home can require payments that eat up 35% of income, leaving families stretched thin and with little margin for emergencies. The rental market tells a similar story. Average rents in McAllen are about $950 per month, but more than 55% of renters are cost-burdened, spending over a third of their income on housing. With limited wage growth and many jobs paying near minimum wage, the region simply doesn't generate enough income to support housing stability. Younger households in particular face difficulty saving for down payments, keeping home ownership rates lower than the national average. The economy is heavily dependent on low-wage industries, retail, healthcare, and cross-border commerce. While McAllen benefits from trade and immigration, these sectors don't create the kind of high-paying jobs that sustain housing growth. The unemployment rate hovers above 6%, and labor force participation is among the lowest in Texas. In fact, nearly 30% of adults are not in the workforce at all, reflecting deep structural challenges. Housing data shows increasing fragility. Homes spend an average of 80 days on the market, compared to 35 statewide. Inventory has grown by 20% year over year, and foreclosure filings are up 18%, largely affecting families with FHA loans. Developers have also slowed activity, leaving half-finished projects scattered on the city's outskirts. New subdivisions often advertise low entry costs, but many buyers still fail to qualify. McAllen's biggest challenge is that it appears affordable, but affordability without strong income support is an illusion. The city risks becoming a market where housing is cheap but still unattainable, trapping families in financial strain and discouraging outside investment. Unless incomes rise, McAllen's affordability will remain more myth than reality. 3. Galveston is a city of contradictions. With about 50,000 residents, it's both a historic Gulf Coast destination and a community constantly under threat from the very ocean that makes it attractive. Tourism, cruise ships, and beachfront rentals power the local economy, but hurricanes and insurance costs are steadily eroding its housing stability. Median home prices in Galveston hover around $300,000, higher than many Texas cities of its size. That's driven by demand for second homes and vacation rentals, but the median household income is just $58,000, leaving locals squeezed out of the very market dominated by investors. More than 40% of residents are renters, and many are now facing eviction pressures as landlords exit the market. Insurance is the biggest crisis here. Coastal properties face annual premiums exceeding $6,000, and many insurers have stopped writing new policies altogether. Without insurance, mortgages become impossible to secure, and cash buyers dominate the market. That dynamic creates volatility. Prices surge when investors flood in, then collapse when storms or regulations drive them away. Climate change makes this worse. Sea levels in the Gulf have risen nearly 8 inches in the past 50 years, raising long-term risks for coastal housing. The data reflects growing stress. Homes take an average of 85 days to sell, well above the statewide average. Active listings are up 40% year over year, and more than 38% of homes for sale have had price cuts in the last quarter. Foreclosures have also risen by 21%, particularly among local families who bought during the pandemic surge when values peaked. The economy compounds the risk. Tourism accounts for more than 30% of local jobs, making the housing market highly sensitive to downturns in travel. When the cruise industry stalled in 2020, housing demand dropped overnight. Now, with short-term rental saturation, many property owners are finding it harder to generate income, pushing more inventory onto the market. Galveston's housing market is stuck in a dangerous cycle. Speculative demand pushes prices up, disasters and insurance costs push them back down, and locals get caught in between. Without major changes, the city risks hollowing out into a place where housing is abundant but increasingly unlivable. 2. Port Arthur. Port Arthur, with a population of about 55,000, is one of Texas's most troubled housing markets. Once a thriving port city, it has been battered by decades of industrial decline, hurricanes, and depopulation. Today, Port Arthur is shrinking, and its housing market is shrinking with it. Median home prices here are shockingly low, around $95,000, less than half the statewide median. At first glance, that looks like a bargain, but in reality, it reflects a collapsing market. The city has lost more than 15% of its population since 2000, and blighted neighborhoods with abandoned homes are common. The local economy is dominated by refineries and petrochemical plants. While these provide jobs, they don't generate broad-based prosperity. Median household income is just $42,000, and poverty rates exceed 25%. Unemployment is consistently higher than the state average, hovering near 7%. With such weak economic fundamentals, even cheap housing becomes a burden for many families. The data highlights the distress. Homes sit on the market for over 100 days on average, the longest of any city on this list. Foreclosure activity has spiked 28% year over year, and property values are either flat or declining. Rental demand is weak too, with average rents around $850 per month, reflecting limited economic opportunity. Hurricanes have compounded the decline. Storms like Rita 2005, Ike 2008, and Harvey 2017 devastated Port Arthur, leaving scars that are still visible. Many neighborhoods never fully recovered, and flood risks remain high. Insurance costs are crippling, with premiums exceeding $5,000 annually for many homeowners, often higher than their mortgage payments. Port Arthur represents the extreme edge of Texas's housing crisis. Here, the problem isn't affordability, it's viability. As population shrinks, jobs stagnate, and disasters pile up, the housing market risks becoming a graveyard of cheap but unlivable homes. 1. Corpus Christi. Corpus Christi, a coastal city of about 320,000 residents, is the largest on our list and the one that best illustrates the structural weaknesses facing many Texas housing markets. Known as the sparkling city by the sea, it has long depended on its port, refineries, and tourism. But beneath the postcard image lies a housing market under mounting pressure. Median home prices in Corpus Christi are about $260,000, still below the state average. But incomes don't keep up. The median household income is just $62,000, leaving a price-to-income ratio above 4-to-1. At today's mortgage rates, the average monthly payment for a typical home exceeds $2,100, well beyond what most families here can comfortably afford. The numbers show growing strain. Homes are taking more than 85 days on the market, compared to 40 days statewide. Inventory has surged by 35% year over year, while foreclosure filings are up 20%. Rental costs have climbed to an average of $1,450 per month, leaving more than half of renters cost-burdened. Insurance is another looming crisis. Corpus Christi's coastal location puts it at high risk for hurricanes and flooding, and premiums have soared past $5,500 annually for many households. Several major insurers have pulled back, leaving limited options and skyrocketing costs. For many families, the insurance bill alone makes owning a home unaffordable. The economy offers little relief. While the port of Corpus Christi is one of the busiest in the nation, its jobs are heavily industrial and volatile, tied to oil and gas exports. Tourism provides seasonal demand, but it's unreliable, and like Galveston, the city relies heavily on short-term rentals, which are now oversupplied, cutting into investor profits and dragging down prices. Corpus Christi's vulnerability is structural. Rising housing costs, weak wage growth, insurance crises, and overdependence on energy and tourism create a fragile market. When storms hit, or when global oil demand dips, the city feels the shock directly in its housing values. Corpus Christi isn't just struggling, it's a warning. If Texas's sparkling city can hollow out under the weight of affordability and climate risks, no market in the state is safe. Texas has long promised opportunity, but these cities reveal a harsher reality. Population loss, weak wages, and rising costs are turning communities into ghost towns. Subscribe to stay ahead and let us know in the comments what housing trends you're seeing in your area.